Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq, with daily insight on the Nasdaq-100 index, or the NDX, which is made up of 100 of the largest domestic and international non-financial innovative companies listed on the Nasdaq stock market. The NDX has been the barometer for U.S. large cap growth and also one of the best performing indexes over the last decade and a half, not to mention one of the most liquid index ecosystems in the world. Joining me this Thursday afternoon, we have Joyce, Managing Director at Nasdaq's Market Intelligence Desk, for an update on technical levels to watch in the Nasdaq-100. And Brian, even though we're taking a look at the Nasdaq-100 index, really the reason why we're seeing the volatility is based out of the bond market, not necessarily what we're seeing happening specific to the stocks.
Yeah, absolutely. So we've been seeing pretty strong moves in yields since the first week in January. There was a breakout from a 7-month trading range on the 10-year Treasury, which is around 85 and 95 bips in that level, and it's been pretty strong momentum to the upside over that time, which is partly explains why we've seen a recent underperformance in the NDX versus, say, the smaller cap Russell and the S&P 500. But what happened in the last week or so, especially and in the last 24 hours, has been pretty extreme.
It's not typical to see that kind of move on a treasury. That almost looks like a stock chart at the end of the day, but it's atypical to see on a percentage basis the kind of moves that we've seen in the 10-year.
Right. Coming into today, sorry about that delay. Coming into today, the move this month to date in the 10-year yield was the biggest monthly net gain since November 2016, and it's like top 3 over the last 10 years. What happened today? In part, what happened was we had a very poor Treasury auction. There was a 7-year auction. It was the lowest bid to cover ratio since 2009, which is when Bloomberg first began accumulating that data. The indirect bidders was a low 38%, and the primary deals thus were required to take down 40% of a $62 billion offering. And there's plenty more of issuance coming down the pipeline. So that takedown by the primary dealers was 2.7 standard deviations above the 12-month average. So that's kind of what was going on in 2019 when we had that overnight spike in very short-term rates. The overnight rates went from 0.5% to 10 percentage points a day or two before an FOMC meeting. So the Fed had a lot of egg on its face right there. Powell just earlier this week, when speaking to Congress, said higher yields were a statement of confidence that the economy is bouncing back and maybe the economy is rolling over, I should say opening up. But when you see these dramatic, violent swings in the Treasury market, which is supposed to be, the safe haven market, and the yields are going to the upside, that's, something I think is concerning the markets. It's certainly a risk to asset prices. So the Fed is going to have, I don't know if it's some explaining to do, but the market is certainly going to want to see, some slowdown in the momentum that we're seeing to the upside in these Treasury yields. So we can see today that we hit 1.61%. Go ahead.
Right. And I think that's exactly what the concern is, to break it down for the audience. So while the Fed isn't seeing anything within the inflation data that they rely on, the global bond markets appear to disagree with that, suggesting that the global recovery is going to happen quicker. Right. So, and I think that's why you see some of that pressure in the NASDAQ names, only because a lot of them have been associated with the work from home, work from anywhere trade. But I think with inflation coming back into the system and a potential rise in interest rates with all this money that's floating out there, I think that's why the Nasdaq-100 is the most susceptible to that.
Yeah, and the chairman is going to be political, I would say, maybe in some regard, or diplomatic, maybe is a better word, where if they are seeing signs of inflation, they may be trying to downplay that because they don't want to add fuel to the fire. But the Bloomberg Commodity Index as of yesterday was up almost 10% in February. That's a 10-year high. Value this month is outperforming growth by 7 percentage points as of yesterday. That's a 20-year high. So, there's big stuff, especially this month, taking place across commodities, rates, and we're seeing that with growth versus value, that, there's some, big secular, there's big moves going on underway, and the markets seem today to be concerned, particularly what's going on in treasuries. There's a lot of issuance coming down the pipeline. Are higher rates a result of inflationary pressures, or is it because there is just so much supply that's expected to come down and foreign buyers are really stepping back? Is it more of a mechanical thing? So either way, higher rates are a problem for asset prices, particularly with growth stocks more so than value. Value stocks like financials are benefiting from a steepening curve, which we certainly have seen. So if I look on this next screen here, this is the 10-year, 2-year Treasury spread. We could see, this is back in early 2019, it was negative. It's rebounded certainly off the lows in 12 months ago in March of 2020. And we've now, hit up to 1.35 percentage points, but you can see this is just a very dramatic rise. This is the 5-year yield today alone. It started off at 60 basis points and we hit 86 basis points. So just a very parabolic kind of move that is spooking the market. When we see how this is impacting stocks, last week we did finish on a week note towards the end of the week, and this is a weekly period candlestick chart of the Nasdaq-100. We closed the week out with the bearish engulfing candlestick, and we have confirmation this week to the downside. We still have tomorrow left to see how this plays out, but certainly a bearish candlestick, which is confirming last week's reversal, and something to keep note of. When we look today at the daily intraday chart, we can see that we do have a support level here at the 12,845 level, but I would note that the daily RSI is now hitting 36. That's the lowest we've seen since March of last year. So, and the price is only about 8% off the highs, I would say. So, certainly some concerning signs from a short-term perspective as to what's going on here in the marketplace. Just wanted to note, we mentioned growth versus value before. We could see this is a 10-year downtrend where value is underperforming, and that bottomed back in November of last year, just a few months ago, and it's beginning to reverse higher. You see the breakout here to the upside in the RSI. This is, again, a ratio of value and growth, and so value here is outperforming. So we'll see how this trend plays out, if this is just short-term rebound. But given the move higher in rates, that does tend to favor value over growth, and I think the Fed's going to have to maybe come out and instill some confidence in that market.
All right, Brian, appreciate the insight. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.